Welcome to another Social Security Nerds podcast. I'm Mike Hayflick, along with my partner, Russ Geiser. We have embraced the complexity of Social Security claiming strategies and retirement income planning.
So you don't have to.
Market volatility has been the name of the game lately, Russ. It seems like since last November, we really haven't seen anything this significant.
Yeah, people have seemed to forget what markets do.
Absolutely. We love the ride up. We love that.
Everyone loves the up. They do come down. April was really the last, I guess, significant little bit of a pullback. The market might have been overbought a little bit. Came back down in April, and then, May recovered all of April, and we've been up even since then.
Yeah.
Up until about a couple days ago, and specifically yesterday, Monday, August 5th. And so we thought it'd be a good idea to kind of touch on what's going on, maybe a little bit in the market, but more importantly, as it relates to our retirement income planning clients and how making the right decisions with your retirement income planning up front can make the difference of how you feel as you go through retirement.
Yeah. And this is just the course of investing, right? This is not unusual. These are things that we talk to our clients about all the time. In fact, usually when the markets are really good, I'm sort of downplaying it and I'm trying to explain to people, this is nice. Don't get me wrong. It's nice to see numbers being higher, percentages higher, but we do know that things will change at times, whether they're temporary, maybe somewhat long, elongated type phases that we go through. If you don't remember, I'll try and remind you here, and you might not like this reminder, but remember back in 2022 was 9 consecutive months of downward. And it was really pressure on both markets, stock markets and interest rate sensitive markets like bond markets. And that was after 21 months of upward, right?
That's right.
Out of COVID. I mean, 21, 22 months up. So when these things happen, Russ, I mean, our job is simply to what?
Our job is to coach our clients. And of course, at least at the very beginning, make sure the strategies are sound, but it's all about education and positioning. And our investment management team does a good job at making the subtle adjustments along the way. But in terms of strategy, we can't time the market. We're not jumping in and out of markets. And we know that markets historically come back. They go up and they go down. Now, when you're working and you're putting money away for retirement and you're what we would call dollar cost averaging into the market, you're in the accumulation phase. Average annual returns matter a whole lot more. And of course, you don't need the money because you're not retired yet. And so you're just accumulating. And a down market can really be a good time to make sure that you're buying more shares, with the same amount of money that you're putting in.
That's right.
And that way on the way up, you can really do well. And so those in the accumulation phase are people who just don't need to pull money out of the market. You can't panic during a time like this. You really have to understand how you're invested. You have to understand where there might be buying and selling opportunities, or if you have cash on the sideline, maybe a good time during a pullback to put some in. But you have to have an overall plan and strategy specifically. And if you don't have to pull money out, you don't need a plan to pull money out, then you leave it alone because, as we're already seeing today, August 6th, Tuesday, markets are starting to come back and recover the losses even just from yesterday. Right. So this is a long-term game.
And we did have a few calls where we had to just basically remind people of like, what's your plan? What's your strategy? Why did we position your wealth the way we did? We have some wealth positioned for short-term use, some maybe for 2 to 5 years, and then some for even greater than 5 years. As Russ said, we're not using it all at the same time. We have to just allow things to happen, make subtle adjustments, and remember the overall plan and the overall strategy.
That's right.
So, Russ, let's talk a little bit about the cost of trying to time the markets. As you said, when you're adding money to the down market, it's really, really good, in fact, because you're buying discounted prices, essentially.
That's right.
But even if you're not adding to the markets, it's important not to just bail out, 2%, 3% down. It's so important not to just bail out of your whole portfolio.
That's right. And that's because the market can be extremely volatile. You can't time it. And so I'm just going to reference from Visual Capitalist here. Just some numbers and some data. Okay. And this is going to be from a period of January 2003 through December 2022. too. So quite a bit of a period here. And if you had $10,000, excuse me, invested in the S&P 500 from the beginning of January 2003 and held onto it all the way to the end of December 2022, your 10,000 would have turned into almost $65,000. You didn't miss one day in the markets. That same investment, okay, if you missed the 10 best days of the market in that period, would have only been $29,708. So you would have made money, but you know, less than half of what you would have made if you held every day of the market. If you missed the 20 best days over that period of time, and we're talking 20 years here, you would have made about $7,800, $17,826. You missed the best 30 days, you're basically at break even. And if you think about inflation, you're losing.
You're behind, right?
And then if you miss the best 40 days and so on, you would have lost money. And that's, again, points to the fact you can't time the market. The best days happen. The 10 best days happen. One was October of 2008, 11.6% in one day, 10.8% in one day on October 28th, 2008. More recently, March 24th of 2020, a one day increase of 9.4%, and so on and so forth. And so the whole point here is just saying you don't abandon your strategy for investing just because you're a little nervous. And frankly, the news doesn't do a good job at making your nerves, putting your nerves at ease. They get paid for clicks, right?
Right.
So
Yeah,
if you have a financial planner or an investment advisor, they'll be telling you the same thing. Stay the course, but it's essential you have a good plan and your investment strategy fits into the financial plan. Now, I'll ask you this, Mike. Now, obviously, the accumulation phase is a lot different than what we would call the distribution phase. Why don't you walk our listeners through what's different about the distribution phase when we talk about market risk? How could that be different?
Yeah. So just like during accumulation, you really don't know what the markets will do. So it's not like something happens when you retire where all of a sudden it's all crystal clear, like a crystal ball. We know exactly what's going to happen today in the markets. We know exactly when to take money from our accounts. It is not like that at all. It's just like when you're accumulating. Maybe you're paying more attention though now because you're not adding to these markets, right? You're not seeing your wealth grow by your own contributions. In fact, you might actually be seeing it being depleted because of distributions. And by distributions, we simply mean use. You're going to be taking from those accounts now. It's so vital to not think you can now time your distributions or think that you can just go on autopilot and say, oh, now that I've accumulated the nest egg, I'm just going to set myself up on autopilot. 5% a year, I'm going to take out of my accounts, maybe do it on a monthly basis. That'll be convenient. Don't forget to account for inflation. So you're not going to take maybe 5. You might be taking 5, 6, even up to 7.5% out of your accounts every year. And if you are just dismissive of the effects that the markets can have on your wealth, we call it, you could end up experiencing dollar cost ravaging, not averaging, where you're actually adding money in to the markets, whether they're good or bad. We're talking dollar cost ravaging. The worst case scenario, Russ, would be you retire, the markets are down immediately. You take your distributions, the markets continue to be down, maybe little ups and downs, but mostly down. Suddenly, the wealth you had accumulated, and it took so long to accumulate, it could be depleted so dramatically that your whole plan, your whole retirement plan and your retirement future could now be in jeopardy. So we have to take a different look. So how do we do that? How do we take a different look when it comes to actually what are we going to do with the nest egg? How are we going to put all the retirement puzzle pieces together?
That's right. And I think the important thing to note is if the more you're relying on the markets for your retirement income, the more stress you put on your plan to actually become successful. I know many people, and we talk about this in our workshops, they use the 4% safe withdrawal rule. And I think it's important to have some context of what that actually means. And I'll talk about that maybe in a second. But the bottom line is the more income that you need from the markets, which we would call, variable income, because we don't know specifically what markets will do moving forward. We know over time they do well, and on an average return basis, they could do well. but now we're talking about sequence of returns.
That's right.
So it just adds this unpredictability, which is why we really, really, really think it's important to make the right Social Security claiming decision for you and your family and your household, because it might make sense to let that benefit grow while you're pulling from the market, to then leave most of your retirement more heavily weighting in Social Security income.
Mm-hmm.
And there's other benefits that can be attributed to that. But we believe that Social Security income combats erosive effects of longevity, taxes, and inflation, because it's guaranteed for life. The higher of the two benefits stay in the household if you're married.
Mm-hmm.
It is tax or can be tax efficient. We know it is, because only up to 85% of it, the Social Security income, can be taxable. And we know that it gets cost of living adjustments every year if the inflation numbers are positive.
Mm-hmm.
That's automatic. It's not guaranteed, because if inflation is at zero, it of course it gets that zero.
Right.
So it doesn't go up. So that is a reliable source of income. And the more heavily weighted that your plan is in reliable income, the less you have to worry about stock market volatility. Now, the planning that we do kind of takes into effect your goals and objectives, which is directly how much do you want to spend in retirement? When is the right age or ages for you and your spouse to claim Social Security benefits? And what is the probability of success you desire? And we back test that through market research and market data. And then we can use other different financial instruments and tools to even drive that probability of success up higher, and essentially get you the lowest cost of retirement of a retirement plan. I mean, the least amount of your own wealth that you need to use. So more of the income in the markets that can just be discretionary, if you indeed have what we would deem excess capital.
That's right. Right. And I think it's important to offer this. We're not trying to say don't invest. The market's not a place for you. We're saying the market's certainly a place to be, but you also should be depending on the market for certain parts of your wealth, for certain objectives. And Russ, you just alluded to this. We think of the idea of, let's say you've retired, you haven't taken Social Security yet. We need bridge capital. We need money to spend. We have to pay the bills. We want you to live the lifestyle you hoped for, but you're not taking Social Security yet. So you have to use some of your own wealth. We certainly don't want that S&P 500 oriented completely, because you don't know what the S&P will do every day. So you want to make sure you have safer money, maybe lower conservative, oriented wealth to spend. And then if you do have an income gap, we think of that as more of a vertical on top of what you'll get from Social Security once claimed. We might need a little more of your wealth, but hopefully it's a smaller, more modest amount, right? For many years from that point.
That's right.
So you have far less dependence on the markets to generate that income gap.
That's right.
In best case scenarios, we have excess capital, extra right out of the gates into retirement. We already know it's extra money. Now you can be a little more market oriented. It won't matter as much. It's discretionary use as you wish, or even maybe legacy.
That's right. And if you want to know where you stand, or you're getting ready to retire and you're looking for someone trusted to be able to figure this out and hold your hand and walk you through this, what's the right decision? What's the right deployment of your wealth? How to properly position your assets? Call us 716-362-7099 or text us for an appointment, a complimentary retirement income stress test if you already have a plan, or just let's start from scratch and figure out where you are and what we might need to recommend for you. Back to the 4% safe withdrawal rule that I alluded to really quickly. A lot of people I hear, and this is like at work at the water cooler, or your uncle is, giving you your financial planning advice, or maybe just a collection of stories that you've heard. There was some research done by Bill Bengen in the 70s that basically studied, what was the safe percent withdrawal rule if you had a 50-50 stock to bond ratio in your investment portfolio over a 30-year retirement period, with an 80% chance of being successful, meaning to not run out of money, to have at least $1 left, regardless of what happened in the markets. And his study was from 1929 to 1979, 50 years of markets. And he found that a gross 4% safe withdrawal rule that included inflation would be the number you could achieve to have at least $1 left with an 80% probability of success. Now,
Right.
most people want greater than 80% probability of success. We have another
Right.
50 years of market data. Some people need longer than 30 years, some need less. And so that percentage changes, and it also changes depending on what your cost is for investment management. And we want to make sure that you're netting, because a lot of people, and when I say net after taxes, you're netting what you actually need, because of course you still have to pay your taxes, and most people have 401k money or IRA money that is all indeed taxable to them. So it's more complicated than just 4%. We have another 50 years of market data, and we're able to right out of the gates tell you and analyze, like, here's where you'll be based on all of these specific parameters. It's very powerful.
And we know that the markets will continue to be volatile. So to base your retirement plan on a calm, smooth experience of 30 years, just think back, Russ, you just alluded to up to 1979. Since then, look what happened in 2000, 2008, 2020, 2022. And
1988, 2000.
so many
early 2000s.
So many, extreme corrections in the
And
markets.
even just back to yesterday.
Yep.
And this is what I'm thinking, because we get phone calls, okay, and we didn't get many.
I think
our clients are well educated and they're prepared and they understand. But you do not want to live and die throughout retirement by, am I going to run out of money? The market's down 5% today. It's down 3% today, and I have to take this withdrawal. You don't want that stress in your life. So get it done, and get it done right. Know and have the information before you retire, before you go from accumulating to distributing, and understand. Don't just go with some arbitrary number. Get the numbers, be specific, and have a plan. And most importantly, ensure you're taking your largest income benefit, likely for most of you, your Social Security income, in the correct manner with the right expertise.
Yep. Reach us 716-362-7099 or go to incomeplannhq.com. We'd love to do a retirement income stress test for you. Thanks for joining us. Hopefully this was helpful to you. Again, common things happen like market volatility. We hope we're here to educate you and guide you. We'd love for you to reach out. Thanks again for joining us.
Thanks for listening, and have a great week. Take care.